On a summer weekend in Carmel by the Sea, Leopold Aschenbrenner stood in a tuxedo at a villa altar and got married. At that exact hour, traders at Citadel were finishing the paperwork to buy his entire stock portfolio at a discount. 10 days earlier, his fund held $45 billion. By the time he said, "I'll do," it held 10. Every headline said the same thing. The 25-year-old who predicted the AI boom had just proven his own prediction wrong. He didn't. The real reason fits in one number, 4. This is the hindsight. To understand why leverage, not the forecast, is what took his portfolio, we have to go back 18 months to the essay that made him famous. 18 months earlier, Leopold Aschenbrenner was 23 years old, and he'd just been fired. He'd spent 2023 on OpenAI's superalignment team, working under Jan Leike and Ilya Sutskever. In April 2024, OpenAI let him go, officially, over a disputed information leak. He says it was retaliation for a memo he wrote about Chinese espionage risk. OpenAI has never confirmed that account, and neither has he proven it. What's not disputed is what he did next. 2 months later, he published a 165-page essay called Situational Awareness: The Decade Ahead. What was actually in those 165 pages? Not a hunch, a detailed, specific bet on exactly which parts of the AI supply chain would get scarce first, and which companies would profit when they did. He was right often enough, fast enough. 4 of Silicon Valley's most credible operators noticed. Patrick and John Collison, Daniel Gross, Nat Friedman. They handed him $225 million to build a fund around it. You might already be wondering, if OpenAI just fired the guy, why would anyone hand him $250 million? Because being right in public is its own credential. The essay wasn't a theory. It was a forecast people could check against reality, in real time. Here's the thing, this isn't a story about whether he called AI correctly. It's a story about what happens when a correct idea meets debt. The fund did exactly what the essay promised. Aschenbrenner built a concentrated, two-sided book. Long the companies making AI physically possible. SK Hynix, Nebius, Micron, CoreWeave, and short the software names he believed the AI wave would hollow out. Adobe among them. But he wasn't only betting on winners. What was the other half of the book doing? Betting that certain kinds of software would be worth less, not just that certain kinds of chips would be worth more. 2 sides of the same forecast. By June 30th, 2026, the fund reported a 439% net return for the first half of the year, not annualized, 6 months. And get this, assets under management climbed from that original $225 million seed to $45 billion. How does $225 million become $45 billion in 2 years? By being right in public for 2 years straight. Backers kept adding capital every time the thesis kept working. Here's what almost nobody focuses on when they tell this part of the story. Every one of those gains was real. The stocks moved the way he said they would. On July 1st, 2026, the fund peaked. So how long did that peak last? 9 days. On July 10th, 2026, SK Hynix's stock started trading in New York. It was the top of the trade. Over the next 10 days, the AI infrastructure names Aschenbrenner had bet everything on, SK Hynix, Nebius, Micron, CoreWeave, fell 35 to 47%. At the same time, the stocks he bet against, software names like Adobe, started climbing. Both sides of his book were losing money at once. Now, a 35 to 47% drop sounds like a disaster. But other investors held the exact same stocks through the exact same 10 days. They lost money too. None of them got wiped out. So why did the same drop that everyone else absorbed as a bad month force Aschenbrenner to sell everything? Here's the mechanism nobody put in the headlines. He wasn't just holding these stocks, he was borrowing to hold them. Picture it like this. You have $10. A lender gives you $30 more, so you can bet $40 instead of $10. If the bet goes your way, you've quadrupled your return on every dollar that was actually yours. But if the value of that $40 bet drops by just 25%, your $10 is completely gone. And the lender wants his $30 back today, not whenever it's convenient. That's leverage. To put it another way, Aschenbrenner was running his public book at roughly 4x leverage. For every dollar an investor gave him, he borrowed 3 or 4 more from Goldman Sachs, JP Morgan, Citigroup, and Bank of America. A 35 to 47% drop in the stocks doesn't cost you 35 to 47% of your equity when you're leveraged 4x. Slow. It costs you nearly all of it. This next part sounds like a contradiction. It isn't. The strange part is what this reveals. The same conviction that made him confident enough to build a $45 billion fund out of a 165-page essay is the conviction that made 4 times leverage feel reasonable. He wasn't reckless in the way people assume. He wasn't gambling on a hunch. He was so certain he was right that borrowing against it stopped feeling like risk at all. That's not a system failing. That's a person. Certain, running out of room to be early. And that's the uncomfortable part of this segment. The same certainty that got him $225 million is the certainty that took his portfolio. So what did that certainty cost him? 6 days later. On July 24th, Aschenbrenner sent investors a letter. What's wild is, the market was already falling, his positions were already bleeding on both sides, and this is what he told them. The sell-off was one of the most attractive opportunities since early 2025. He asked them to wire more capital by August 1st. He wasn't trying to save face. He believed it. You might be wondering, didn't the banks lending him the money know he still believed in the trade? They didn't care. Margin calls aren't a referendum on your thesis, they're a referendum on your collateral. 3 days later, the market gave its answer. A rate hike-driven sell-off hit July 27th through 29th. The value of everything backing his borrowed money kept falling. Why? Why would 4 of Wall Street's biggest banks all come calling for the same loan in the same week? Because the collateral behind it, his stocks, had just fallen enough to erase his side of the bet. Goldman Sachs, JP Morgan, Citigroup, Bank of America, the same banks that lent him the money to run the trade at scale. All 4 came calling for collateral he no longer had. He didn't have a choice left to make. On July 30th, Citadel bought his entire public portfolio, roughly $16 billion, at about a 10% discount. Why would Citadel only pay 90 cents on the dollar? Because a forced seller, with 4 lenders calling at once, doesn't get to negotiate price. And that's the part that's easy to miss. His lenders never disagreed with his thesis. They just couldn't wait for it to be proven right. $45 billion. $10 billion. A $35 billion loss in a single transaction. The letter asking for more money was 6 days old. So what actually survived the fire sale? The part that was never on margin. His retained private holdings, including a stake in Anthropic, weren't leveraged. Nobody could call a loan against them because there was no loan. With those intact, the fund is still up roughly 80% for the year. But here's what really happened. The prediction never failed. The man who lost $16 billion in a forced sale was right the entire time. Which is a strange kind of vindication, the kind that costs you $35 billion to receive. Remember the villa in Carmel by the Sea, the wedding, the same weekend Citadel finished buying his stock. Somewhere in that same 48 hours, the unleveraged part of his portfolio kept being worth exactly what he'd always said. No lender to call, no forced sale. I want you to sit with this for a second. Being right about the future and surviving your own bet on it turn out to be 2 completely different skills. Conviction doesn't ask you to be careful. It asks you to be certain, and certainty is exactly what makes 4x leverage feel like common sense instead of risk. If this is the kind of story you come here for, subscribe. There's a new one every week.